Well, those are the headlines we are tracking for you. And first up, let's get to the topic of debt funds. So much has happened, like I said, all through 2021. I think the year started off with a lot of enthusiasm after some of the long duration funds gave double-digit returns. Gilt funds have been giving double-digit returns for the last few years. However, in 2021, the picture changed a little because there was the spike in yields. And then, of course, last week came in the big notification from SEBI, which sort of did ask mutual fund houses to trim their exposure to certain kind of bonds. How will that impact the unit holders of these mutual funds? Could they see a cut in their NAVs? Furthermore, there's also a change in how these debt funds are going to value these bonds in question. So let's understand the impact of all of this, what it means for the investor. I have with me a very special guest, Mr. Mahindra Jaju, the CIO of Fixed Income with Mirae Asset. Mr. Jaju, thank you so much for taking out time and joining us today on The Money Show. So to start with, AT1 and perpetual bonds, these are the instruments in question which SEBI has said that, look, as debt, it's debt funds that hold these kind of bonds. And now SEBI is saying, look, don't hold more than a certain amount. Don't hold more than 10% of the fund NAV. And further, the ones that you have, you need to change the way you value them. So let's understand that, firstly, what's the intent behind the regulator in doing something like this?
So clearly, we have a situation now where in case of Yes Bank and then in case of another bank, the AT1 bonds were completely written off. That's the first time that one experienced that kind of a situation. And given that change in how some of these long-held beliefs changed, there was need to recalibrate the risk management framework for the mutual funds. So this issue has been under discussion for a long time now, and eventually it's a good measure to have reasonable restrictions or cap on how much of these bonds should be held, because the whole debt market space continues to evolve over the last couple of years. We have seen multiple circulars and new set of regulations for the debt mutual funds, which has continued to improve the risk management framework for these funds. So this is one more measure in the same direction.
All right. So, when debt funds include these category of bonds, and I'm, asking this to you, purely from a retail investor perspective, how did it essentially enhance maybe the return profile of these debt funds? What I want to understand is what's the role that these perpetual and AT1 bonds, they're very distinct in nature, right? I mean, there's no maturity date as such. So what's the role they played in enhancing the return profile, maybe the risk profile as well, for these debt funds?
Well, the perpetual bonds are a very different type of instrument which are used as equity by the banks which are the issuers of these bonds. So this is a kind of a hybrid instrument, and then it has only call, and the issuer has the option to either redeem the bonds on the call date, or it can be a bond forever, which is why it is called perpetual bond. The normal market practice is that the call option is generally exercised by the issuer. Now, because of these specific features, which also includes the possibility that if the issuer of these bonds does not have adequate cash flows or the profitability, then the bonds can be completely written off, like what happened in case of Yes Bank. These bonds typically trade at a spread or at a yield much higher than the conventional regular fixed income instrument. So let's say if one of the perpetual bonds is trading at 300 or 400 basis points or 3 to 4% yields higher than the regular bonds of the same bank or the same issuer, then there is a significant yield pickup which happens because of these bonds. So the funds which invest in these bonds are able to generate or have higher YTM for that reason.
Okay, all right. Now, these two changes that have been recommended by SEBI, Mr. Jaju, let's understand firstly, What are the debt funds? I mean, there's a wide umbrella, right, of debt funds. You have long duration, medium duration, liquid, banking and PSU, so on and so forth. So commonly, which category of debt funds do you find these kind of instruments? And secondly, what could be the likely impact?
From whatever information and analysis I have, primarily these bonds are in the banking and PSU debt funds, and in the credit risk funds, and to some extent in dynamic bond funds and hybrid equity funds, which is the right position for some of these papers. There are a few odd schemes here or there which have some exposure to these bonds, but largely this is concentrated in this category. Historically, these bonds have given a higher yield. These bonds have done well, so it was okay. Now there is a change in the underlying environment, and therefore it is appropriate to evolve a new set of risk management framework. And SEBI, under its circular, has given the grandfathering for the existing investment. So therefore, there isn't much impact that one would feel if only the cap on the holdings were to be given. However, there is one additional provision, because so far these bonds were valued at the call, which means that even if the bond is a 100-year bond, the pricing or the valuation was done with the next call, which typically used to happen in the next 5 to 10 years from the issue of the bond. Now the SEBI new requirement is that these bonds should be valued as if they are a 100-year instrument. Now, obviously, if you extend the maturity to 100 years, it will have some NAV impact. And that is the concern which some of the investors have. I personally feel that it is not a very big, challenge, because these bonds are all issued by good banks, and we have not had any major, unfortunate event with these bonds. And these bonds are regularly traded in the market. So as far as the valuation waterfall mechanism is concerned, first we have to take the traded price. And then if there is no actual trade in the market, then we have to go to the theoretical valuation framework, where there is a reference price because these bonds are traded. So therefore, the theoretical basis of trading, valuing it at a call or whether you value it at 100-year, should not make a big difference if these bonds are actively traded in the market. Now, obviously, the days when these bonds are not traded or when there is illiquidity in the market, the valuation challenge will come. This, in my view, is a short-term challenge, because whenever there is a new regulation, whenever there is a stronger risk management framework, there is this transition period during which there is going to be some impact. Now, the impact will be higher if there is more uncertainty and nervousness in the market. I think after the first couple of days, the situation is back to stable, and I don't think that it is a big issue. Of course, there will be some impact on the NAV and some impact on the valuation for a while. But then if you look at the long-term trajectory of the debt funds, there have been so many challenges that the debt mutual funds have faced. But apart from isolated and localized impact, by and large, I think debt funds over long term have the ability to recover from these kind of events, which eventually, with the new framework, makes them still more attractive and safe.
Okay. You mentioned about how the fact that these are perpetual bonds, they do tend to carry a bit of a higher yield. Mr. Jaju, now that you'll have to sort of curtail the exposure that a mutual fund has to these instruments, could it maybe cap the return opportunity as well, or do you think that any which ways mutual funds did not really have that big an exposure to these kind of instruments?
See, return opportunity, there are multiple sources. There are interest rate movements, there are other corporate bonds and so on. So this was one option. Now, if this option is kept, then obviously there are the second and the third options. This was a good category. Largely the issuers were the banks and the high quality corporates. So it was a good combination of getting higher yield. But then, as a theoretician perspective will tell you that there was maybe in some sense underpricing of the risk in the valuations that were reflecting in the NAV, because there were elements of the uncertainty about the exercise of the call option in case the stress situation changes. There were issues in terms of the liquidity discount that needs to be applied in case the trading in some of these bonds is not frequent or regular. And then there was a question about the credit rating and the relative valuation, because not all banks are rated AAA, not all corporates who issue these bonds are not AAA. So there was a risk profile which was somewhat different to a regular bond, and then there was a return. So I don't think that in the long term the returns of the debt funds will be impacted in a significant way, because there are so many other sources of generating return. This, of course, will bring down the YTM by a few basis points in the short term, but in the long term, as we have seen over a period of more than 25 years that the debt mutual funds have been there, one source goes, then there is another source which comes up. So I am more optimistic than that in terms of the continued competitiveness of the debt funds.
All right. Speaking of movement in interest rates, just as we speak, in fact, we have a news flash that says US yields have exceeded 1.75% for the first time since Jan 2020. Now, I think this is the phenomena that we have been seeing, for the last one odd month, where there's been a spike in yields. In light of that, what is the the view on debt fund return, debt fund performance? Because in 2020, interest rates around the world were obviously cut. So we saw long duration debt funds doing very well. This year, if we see a spike in yields, and by the way, we are seeing that, what category of debt funds is slated to, do well then?
Yeah, I think that interest rates are heading higher. We have already seen the preview in the last 3 months. And as you rightly said, the global bond yields have gone up, and I believe they will still head higher. And then we have a huge supply in the domestic market, both from the government side, and if the economy grows at 10%, then from the corporate side. So there is going to be some, headwind for the interest rates, although the Reserve Bank is very clear that they don't want the interest rates to go up significantly or in a disorderly manner. So there is a strong tailwind or support which comes from the Reserve Bank. Now, if the interest rates go up, then the duration funds will obviously have the short-term volatility or a period of negative returns. So from my perspective, investors with a long-term investment horizon of 3 years or more, they need not worry about the short-term fluctuations or change in the direction of the interest rates, because when the interest rates go up, the new money and the maturities will be invested at higher yield. And therefore, once the interest rates again stabilize and come down over, say, a period of 3 years or more, the investors will get a lot of good return. However, for people who have a short-term investment horizon, or who do not want to remain invested for 3 years, or who think that the interest rate volatility is not something that they want to accept or tolerate, then there are the liquid funds and the low duration fund, which in this environment will, in my view, be appropriate for the situation where one thinks that interest rates can go up significantly.
So right now, Mr. Jaju, we always say that when you want to invest in mutual funds, you do so with a goal or an objective in mind, especially retail investors. So let's say if someone, has a goal that they would like to achieve in the next 3 odd years, which debt fund would you recommend they park their money in?
Well, if someone has an investment horizon of 3 years or more with a goal-oriented approach, I would think that a corporate bond fund or a banking PSU fund or a long duration fund is more appropriate, because those are the funds which can give you good return when the interest rates work in your favor. And right now, as we all generally agree that interest rates are looking to head higher, and therefore it is reasonable to assume that in the next 3 or 6 months, the fund will be able to get opportunities to invest the new money and the maturities at a higher yield. So I believe that person with a long-term outlook should not worry about the short-term fluctuations in the interest rate. They should approach the investing as a asset allocation approach and remain invested. And I'm sure that once the current interest rate cycle is complete, then they will be having a good experience with these funds.
Okay. Well, Mr. Jaju, we leave it at that. Thanks so much for joining us then today on the show and, just helping our viewers make sense of all that's happening in the universe of debt funds. And boy, there's a lot happening, but the spike in yields, the latest from SEBI as well.